Hello everyone and a very warm welcome. I'm Myron Jobson and I'm delighted to be your host for today's Investment Insights webinar. I'm joined by Oliver Jones, our Head of Asset Allocation, and John Wyn Evans, our Head of Market Analysis, two people who stay calm and analytical even when markets try their best to unsettle us. This webinar comes at an especially interesting time. The conflict in Iran, though thousands of miles away, has created very real ripple effects for investors, not least because of the jump in oil prices, contributing to heightened market volatility and affecting the value of investments, pensions and stocks and shares ISAs. Then there are the tariff developments. As we near the first anniversary of what President Trump dubbed Liberation Day, when he introduced a wave of tariffs on imports from around the globe, key questions remain. The US Supreme Court struck down those tariffs on the 20th of February. I know that date because it was my birthday, which turned out to be a much busier day than planned as a result. But the full implications of these tariffs are still emerging, and it's unlikely this will be the final word on the matter. And with a new tax year approaching and ISAs and pensions allowances resetting, it's understandable that some investors may be feeling a little uncertain. All of this reinforces a simple but essential point. Avoiding overexposure to any single region, sector, or asset type is crucial. Diversification remains central to effective investment management, and that's a key theme for today. Oliver and John will help cut through the noise, understand the forces shaping the markets, assessing the risks worth watching, and also identify where longer-term opportunities may be emerging, even amid volatility. And as always, we love your participation, so please share your questions in the chat at any time, and we'll cover as many as we can during the session in a dedicated Q&A at the end. So there's plenty to cover. So let's get started. John, Oliver, thank you very much for joining me. And actually, Oliver, I would like to start with you with the first question. So let's start with the impact of the US airstrikes on Iran, which have caused energy prices to surge. So can you put the risk to the global economy and markets into context for us?
Yeah, thank you, Myron, and good afternoon, everyone. Like you said, I think the best place to start with this is by just showing energy prices in context, really. So we've seen the price of a barrel of oil rise from $60 at the start of the year to more like $100 now. I'm just going to show on screen in a moment exactly what that looks like in a bit of broader context. So you've got the price of oil there with the blue line. I've also put the price of UK natural gas with the green line. You can see on that right-hand side of the chart that there have been that the moves recently are significant, not quite as large as those that we saw from 2020 through to 2022, but still significant nonetheless. This will make a real difference to inflation. So take the UK, for example. We're already seeing the impact on petrol prices. From June, we'll see the impact of that increase in gas prices on our energy bills. Around the third quarter of this year, that will probably be adding about 2 percentage points to inflation. So inflation, we think, would have been about 2%. It's likely now to be about 4% in the third quarter of this year. Similarly, in the US, we'll see an impact, not quite so big because they don't have that gas price dynamic at hand. They've got a much more insulated gas market. But again, gasoline prices still beginning to rise in the US. That will probably add about a percentage point to inflation there. So that will take it to 3.5%, we think, later this year. Plus, there'll be some additional effects on things like food prices, the cost of a plane ticket, for example. So in each case, there will be a noticeable effect on inflation. But when we speak to clients about this, a lot of people have 2022 in mind. They think back to that experience after Russia invaded Ukraine. There are some really important differences to that situation. I'll show that in my next chart on screen in just a moment. People often forget that when Russia invaded Ukraine, there was already a significant inflation problem. So you can see here in the UK, inflation was already above 6% before the Russian tanks rolled over the border into Ukraine. So it wasn't just about the impact of energy prices from Russia's invasion, but Also that post-pandemic environment, very, very supportive fiscal policy, multi-trillion-dollar spending packages in the US. Interest rates, they were still at rock bottom levels from the depths of the pandemic. Labour markets, they were the hottest they'd been in 50 years in the UK's case. So workers really had a lot of bargaining power to push up wages. So back then, there was a much bigger, broad inflation problem than there is now. Look at the right-hand side of the chart. You can see that inflation in the UK has been falling recently. It's down to 3%. Why do I mention this? Well, it really matters for what might happen to interest rates. Again, back in 2022, interest rates increased by a huge amount, by 5 percentage points after the invasion of Ukraine. We think something like that is far less likely this time because that much broader inflationary backdrop is missing, essentially. And that's a positive thing as far as the impact on economic growth is concerned. So again, 2022, there was a very big slowdown in growth because you had an energy shock and an interest rate shock at the same time. This time around, we're unlikely to see such a big increase in interest rates, and it means that with energy prices at least where they are now, the impact on growth will probably be much more manageable. So global economic growth probably on track to be about 3% this year. What's happened so far might take 0.1 or 0.2 percentage points off that. We have to acknowledge there's lots of uncertainty. I'm sure we'll get into more detail what might happen next. But I think that context just is really kind of a useful illustration. We're not in a 2022 style scenario at the moment.
Yeah. No, thanks for that, Oliver. And actually, just one last thing on energy. Is it a case that the concern is not just because all energy prices have spiked, but is a concern over how long it may stay elevated, they may stay elevated?
Yeah, exactly right. So the kind of statistics that I talked about, adding 2 percentage points to inflation in the UK, 1 percentage point in the US, that's based on an assumption that energy prices stay at these elevated levels for a year, for example. So exactly, that's something we're kind of factoring into our thinking. If energy prices reverse very, very quickly, unlikely to see a kind of significant lasting inflationary effect. But that, of course, is the concern. You know, there's disruption to energy shipping for an extended period of time. We think the oil market's factoring in between 1 and 3 months of disruption to shipping in the Strait of Hormuz. If it lasts for much longer than that, we might see a bigger impact and therefore bigger impact on inflation than what I've been talking about.
Sure. And so you've talked before about some of the structural features of our portfolios designed to build in some resilience against this sort of shock. Can you remind us of what they are?
Yeah, I think I've been in the studio many times now talking about this theme, but it's a really important one. So something we've been talking about really since 2022, 2023 is that the likelihood, the chance of these kind of inflationary shocks, like the one that we've just seen, has increased. So we've adapted our portfolios to be resilient to that kind of shock in a lot of ways. So in our fixed income holding, in the bonds that we hold, we have shortened the typical maturity of the bonds that we hold. Shorter maturity bonds tend to be much less sensitive in price to these kind of inflation shocks. We also hold more inflation-linked bonds, so where the cash flows are directly linked to inflation, again, a kind of obvious form of additional protection. We hold diversifying strategies as well, so I'm talking about things like macro funds, multi-strategy funds, which are often quite well placed to take advantage of this sort of thing. And then just one final thing to mention, which is in stock selection, we kind of allocating directly to stocks which can benefit from structural themes like Europe rearming, Europe strengthening its infrastructure in response to this much less certain global environment. So yeah, those are a few of the things that we've been doing.
Yeah, sure. John, I want to bring you into the conversation. So tell us a bit more about gold in this context. What's been driving it recently?
Yes, thanks, Myron, and good morning, everyone. I think this also proves that we're not going to shy away from some difficult questions, because the gold price has come back down quite sharply in the last few weeks. Having started the year at about where it is now, it went up 20%. It was at almost $5,500 an ounce, and it's come back to pretty much where it started. But then put that into longer term context, it's up about 35% from where it was a year ago. And I think structurally, if you want to to a really big zoom out, you can go back 6,000 years and sort of track the gold price and what value it has over that period, and it tends to retain its value against assets that you can buy. One of the sort of benchmarks that people use for gold is it will always buy a very fine gentleman's suit. Now, I think at $5,500, we were very much in Savile Row territory, so I think it was probably, not unexpected that it came back a little bit, and there was signs, I think, of very speculative activity and people, using borrowed money to buy gold and that sort of stuff at those levels. So we've had a sensible shakeout. Gold is used as a diversifier against a number of risks. I think, people like to feel it's there as a sort of geopolitical risk hedge against major events. Also in the long term, though, it is an inflation hedge, we believe, but it doesn't always work in the very short term, it's fair to say, because you get other market dynamics using it. And we've also seen, particularly since 2022, when sanctions were placed on Russia and it lost access to its dollar-based paper assets and treasury bonds and stuff like that, it had to diversify its assets away into gold, and other central banks around the world have done the same. They've been the main buyers of gold really for the last 4 years. We still have seen it, we've seen it creeping into retail and institutional portfolios, but not yet necessarily in a way that I think could still be kind of increased in the longer term. Yeah. But as far as we're concerned, it's something we want to stay with strategically for the long haul.
I was about to say, John, so given the recent volatility of the price of gold, are there now question marks in terms of their role as a diversifier within a portfolio?
There's always going to be question marks, because on the basis that you would think, well, hang on a minute, war is the sort of thing that should make gold go up. But again, if you look over a longer period of time, I think you have to treat that volatility as something that you can actually potentially take advantage of, when it's had a sell-off like it has done now. So we're still committed to it.
Just very briefly on that point, it shows the value of having gold, but also other diversifiers, the kind of things that I mentioned, the macro funds, multi-strategy funds, even the short-dated inflation-linked bonds in a portfolio. So we don't just think about it through gold as being that only form of additional protection.
Sure. And John, taking a step back from the Iran news, another theme you've been talking about recently is regional diversification, including a more positive view on developing markets. What's behind that view?
Okay, well, we'll take that in two layers. First of all, in terms of kind of more broader global diversification, this is particularly in terms of our equity exposure. We want the ability to be able to invest in the best companies of the world, wherever they may be, and not to be confined just to investing in UK companies, although there are many very fine UK companies. So to that extent, taking the position of having a broader global exposure in portfolios is something as well that's been, I think, running through most of the wealth management community, and I think we've shown some leadership in that over the last few years. And interestingly, if you look back to last year, that was a period during which US equities, having been very, very strong, had, they did a decent year last year. S&P 500, I think, was up 17% in dollar terms. It was somewhat less in sterling and euro terms because of the weakness of the dollar. But things like emerging markets, European markets, and the FTSE 100 all outperformed it as well. So if you'd been fully committed to the US, you'd have definitely lost out last year. Yeah. This year it's been, slightly different. At the beginning of the year, emerging markets and European equities were doing quite well. They've been put a little bit on the back foot by what's happened in Iran. And now, funnily enough, US equities are actually providing a little bit of a kind of stabilization in the portfolio, as well as the dollar increasing in value again a little bit as well. So again, it all helps to damp down the volatility during these sort of moments. Specifically to emerging markets, it's more a case that we had a more sort of negative opinion of emerging markets, particularly because of China and the problems that was still going through. So we sort of neutralised that position as much as anything else. But we see I think positive trends and developments. We'd seen, for example, if you look at the earnings growth overall of emerging markets, it's starting to pick up. There's greater breadth of earnings growth in there as well. We do a lot of quantitative modelling on this front as well, and that was, showing emerging markets as coming up, or developing markets coming up on our scorecard, as it were. And again, I think the whole developing market sort of umbrella is a bit of a misnomer these days when you look at some of the companies that you can buy and what they're involved in, and they're at the forefront of many of the new leading technologies, for example, and we want to have exposure to those as well.
Yeah. Oliver, actually, do you have anything to add to that in terms of from an asset allocation point of view?
Yeah, John kind of touched on this briefly, right? The importance of China. In most of the time that I've been thinking about and researching developing market, emerging market equities, China has been the key thing, right? In the 2000s, in the 2010s, what was happening to China, and especially what was happening to China's property sector, that really determined whether the rest of emerging markets outperform the rest of the world or underperform the rest of the world. But what's been really interesting in the past probably year and a half is how that has changed. So part of that change has been all the investment spending that's been going on in the US on AI. That might sound odd, but the reason is that the biggest suppliers to the US tech firms of the chips, of the memory that they need for their data centers are in developing markets, in Korea and Taiwan in particular. Then there's a kind of one more step removed from that, the strength of industrial metals prices, again, which has happened despite China's property sector still being in the doldrums. So that's partly down to what's going on with AI, but also much broader things, the energy transition, countries prioritizing energy resilience, linked to what we've been talking about right at the start of this webinar. And then a couple of other sort of interesting themes as well. So countries in emerging Europe actually benefiting from Western Europe rearming. Eastern European countries are tied into those supply chains, so that's helped. And finally, just some positive domestic growth stories across emerging economies that have happened, again, despite that continued weakness in China. So again, John sort of mentioned that all the quantitative things that we look at on the earnings side in particular, we've seen an earnings cycle picking up, gathering strength in developing markets, despite weakness in China. And that's a real difference to what's happened in the past. And yeah.
And are there other factors behind the broader strength of profit growth in developing markets?
I mean, I've mentioned the key things really. It's first of all that AI-related CapEx, investment spending from US tech firms. Now, some people kind of worry about that a bit in the context of rising energy prices, but it's worth pointing out that AI investment spending, those data centers, they're exposed to US power costs mostly, and the US is really insulated from what's happening in the Middle East, has much more to do with the domestic gas market in the US, even other sources of energy. So that's a potentially resilient driver. We do watch that AI spending very, very carefully for signs that it might be becoming less sustainable. We have seen the companies that finance it issuing more debt since late last year, but they're starting from a very strong starting point. They've got strong balance sheets. So that positive earnings driver, I think, can continue.
Sure. And so how might that strength in profit growth interact with the volatility that has followed with the strikes on Iran? What are the risks to developing markets there?
We've been thinking about this really carefully, as you would expect, given just how significant those moves in energy prices have been. Across developing markets, I mean, John always reminds me that developing markets is a kind of very broad umbrella term that captures a huge range of countries, right? And that's very true in these circumstances as well. Some emerging economies are very exposed to higher energy prices. Some of those in East Asia in particular, they're big energy importers. But there's a range. There are some in the middle, countries in Latin America that kind of neither big importers or exporters of energy, and then some which are energy exporters. So there's a mixed bag in there. There are opportunities. There are countries that are not too heavily exposed to what's going on. I've mentioned it earlier, the actual companies in East Asia that are benefiting, the demand ultimately is coming from the US, from this AI-related CapEx, so that provides a degree of protection as well. So, we speak to some people who assume that in this kind of environment, you have an energy shock, some impact on global growth, that developing markets will be in the crosshairs first, but I don't think that's necessarily the case this time.
Yeah.
I think it's a case of looking at things relatively as well, because it may well be that Europe is even more hurt in some ways by increasing energy prices in that environment, and possibly slightly lower growth base to begin with as well. You think that the developing markets have a sort of greater cushion to continue to grow.
It also just kind of worth mentioning the structural themes that we think about. So what are the structural sources of demand which might actually benefit from this geopolitical instability? One is the energy transition. Well, that's linked to demand for industrial metals, many of which are ultimately produced in Latin America. So that's a kind of potential indirect beneficiary. And another is this European push for rearmament, and Europe also building up its own infrastructure. And again, as I mentioned earlier, actually many companies in emerging Europe benefit from that because they're looped into those supply chains.
Yeah, and I think just to round off on that particular point, I think it's a really interesting juncture right now with what's going on. So if you think about it, we've had some really big sort of alarm calls, even just in this decade, in terms of supply chain management and how vulnerable they are. So we saw it with COVID initially. We then saw it when Russia invaded Ukraine. I think to some degree it was there with also the tariff announcements. You mentioned Liberation Day earlier on, and now it's happening with the attacks on Iran. And it's almost as if the alarm's gone off 3 times and we've hit the snooze button every time. And sometimes you've got to get out of bed and do something. And in terms of securing supply chain security around the world, and lots of countries are going to have to do this. They're going to have to build more redundancy into supply chains. They're going to have more inventory, all this sort of stuff. That is going to be a longer term and structural source of demand for a lot of the services, and particularly the commodities that are, tend to come out more of the developing economies as well. So I think, hopefully this will create a big difference. And Oliver particularly mentioned, the potential for renewable energy as well, and everything around that. Again, we just had another instance here of how dependent the world is on these sorts of supplies from the Middle East.
Yeah, I want to zone in on AI, artificial intelligence, what you discussed, Oliver, and I just want to discuss it with you, John, while we're on topic. So how is sentiment towards it evolving in markets more broadly?
Yeah, well, we've been through, again, some interesting times on this one. I mean, we've been flagging up for quite a long time that there was this risk for the big spenders in AI, if you want to call it that, the hyperscalers, the people who are building the big data centers. So it's mainly American companies. We're effectively talking Amazon, Alphabet, Meta, which used to be Facebook, and Microsoft. Those are the big ones, and also Oracle. And, in 2026, the amount of capital expenditure is going to be in the range of $600 billion on building out data centers, and it's going to carry on at that range and bigger for the next few years. They're highly committed to the growth in this side of the business. Now, that means cumulatively there's going to be $3, $4, $5 trillion worth of capital having been spent. And for good 2 years now, people have been sort of questioning what are the returns on that going to be. So there's already a degree of skepticism built in, and we've seen the Magnificent Seven companies, for example, not performing so well recently. Although they're still very strong, and there's nothing like the risk that you'd have had back in 2000, when a lot of the growth was from very flighty companies with no revenues at all, companies with huge amounts of debt. These are exceptionally profitable companies, as Oliver said, spending out of cash flow at the moment. But the question is that cash flow going to get a decent return? Because it means that people like us and businesses are actually going to have to pay for the services that they generate. So that's one sort of layer of uncertainty, I think, and the questions are not answered yet, it's fair to say. The next sort of layer I would look at in this picture is the companies who are providing all of the sort of material and services and everything that goes into the data centers. Now, the key one here has been NVIDIA with its chips, and it's now the biggest company in the world. I wouldn't say it's come from nowhere, but it's really come up a long way in the last few years, and it's the dominant player there. And there's no reason to expect it won't be for quite some time to come either. But it's not just the chip companies, it's the people who are providing everything from the racks to the cooling systems to the wires and everything that goes into data centers. And it looks as if the spend on this is going to carry on building out for some time. Maybe some risks with higher energy, there may be some risks if some components are not available and that sort of stuff because of what's going on. So things are a little bit up in the air right now, but the trend is still positive. Then to come down to the bottom of the stack, it's actually the companies and individuals who are using AI and how that will enhance their businesses, their profitability, our lives, whatever it turns out to be. Now, again, there was a big study put out by MIT last summer suggesting that only 5% of companies, sorry, I'll say again, 5% of companies who had sort of tried to put in place any AI solutions had seen any benefit from it. And they basically said, well, AI doesn't work, does it? But when you read the document more deeply, it turned out that what a lot of companies were trying to do was just to use a kind of generic large language model to sort of plug into their business and just let it run. And actually you need some proper application specific tools to your business to get the right things out of it. And I think people are beginning to learn that, and we're beginning to see more of the benefits of that coming through. So, will there be a massive productivity boom from AI? I don't know whether it'll be a boom, but I think it should be more positive. Against that, we're going to have to be thinking about what it does for jobs growth overall. There's lots of talk already about difficulties for younger people, graduates getting into the jobs market, all these sorts of things. So as ever, I think there will be a circumstance of winners and losers, and this is obviously where we're really going to lean heavily on our research analysts in terms of their stock and sector coverage to try to pick out the ones that are going to benefit from that and to avoid the ones that are going to lose as well.
Yeah. And actually, on the applications point of AI, is there a sentiment now that as an increased number of companies are adopting AI systems and models into their, I suppose, infrastructure, into their day-to-day, that they themselves are now becoming AI plays somewhat unwittingly?
Well, AI plays possibly positively, but people are talking about the negative side as well, particularly for software companies. This idea that do you need to kind of buy into will you need to have the sort of the software package that somebody sells you, or could you design something yourself, as it were? This idea of vibe coding. Now, at the margin, that might be a problem, but I think generally for the big companies who need security in what they do, they maybe have regulatory oversight. So, if they're buying something off the shelf or getting somebody internally to generate and it makes a mistake, they could be liable on that basis, either financially or judicially, as it were. So you'd have to see how that would develop. So I think and I think people talk about AI as like one sort of singular concept, and there are so many different strands of it that we're trying to untangle at the moment.
Sure. Can we talk about tariffs?
Why not? Let's do that.
Should we start with the basic question? What is the state of play now when it comes to tariffs? Oliver, I'll come to you first.
Sure. So, you mentioned it back in your introduction, the tariffs which President Trump imposed back in what he called Liberation Day last year, they were authorised under an International Economic Emergency Powers Act. They have been struck down by the Supreme Court, so these are the very high bilateral tariffs. Those are gone. President Trump has tried to replace them using another act which allows him to temporarily impose a blanket tariff on the rest of the world. That applies for, I think, 90 days and then would require congressional approval to continue, which he might well struggle to get. I think that he will try to plug the gap, potentially, if he is not allowed to extend those tariffs with other things. There are a host of other legal mechanisms that can be used, and indeed some of them have been used so far, things that target specific sectors like cars, for example. So I suppose two big things really. One, I think the moment of maximum danger to the global economy on tariffs is past. That was last year. The very highest tariffs are gone. But the fundamental change has not gone away. Tariffs will still be significantly higher than they were before Liberation Day, and there's been a fundamental change to the global trading system. Actually, again, to kind of hark back to something I was talking about earlier, relates to the much broader point that we're living in a world where inflation's likely to be a bit higher and a bit more volatile. Inflationary shocks like tariffs, like these geopolitical events happen a bit more often. So all those things that I mentioned earlier on, those shorter dated government bonds, inflation-linked bonds, all those diversifying assets, they're really important because there are many things happening in the world, political, geopolitical, that all kind of add to inflation risk.
Yeah, I mean, I think we just have to accept that tariffs are here to stay, for the foreseeable future, but not at sort of super punitive levels necessarily.
Yeah.
So as Oliver said, it's 10 to 15% for the US. And Trump has also decided that tariffs are his weapon of choice. So I've just noticed in the last couple of days, he's basically told anyone if they try to deliver any oil to Cuba, they will have tariffs placed on them, for example. So that's another subject we could go into. That's probably where he's going to pivot to next for his next victory, as it were. And I don't think we should forget that tariffs are used by the UK and by Europe, particularly against China. And the effective dumping of certain products in Europe. It's things like electric vehicles, for example, which have been flooding the market there. I think the UK only in the last few days has imposed some extra tariffs on Chinese steel to try to protect our steel industry, for example. China creates far more steel than it needs for its own uses and has been pushing all that out onto global markets. So it's not a purely US phenomenon. It is something that is used as a trade tool and as a protective tool by other countries too. But as Oliver said, I think the point of maximum fear and pain is well behind us now. I think companies have found ways around, if not found ways around tariffs, how to live with them, and probably taken out other costs to account for it as well. So it's part of the furniture, I'm afraid.
Sure. And actually, just to wrap up this segment, actually, so and this is to you first, Oliver, if that's okay, what are your key messages from a positioning point of view?
Yeah, so, two key things I would mention. First of all, we begun this by talking about Iran. What's happened in Iran recently is a prime example of one of these moments in markets where uncertainty is extremely high, the news feels like it's changing every hour, markets are volatile, it's emotive as well, it generates an emotional response. These are times when it really pays to avoid a knee-jerk response, to have a really disciplined, systematic process. We've briefly mentioned elements of it earlier today in terms of how we thought about developing markets, for example. But I just think at times like these, having a process which is grounded in evidence, grounded in things that we know have worked in past cycles, just serves us so much better than being whipsawed by the headlines. So that's what we're putting emphasis on at the moment. We're still invested and we don't want to make knee-jerk reactions. Our process will guide us as to if and when either opportunities do emerge or we need to become much more cautious, but that's kind of number one key thing to emphasize. The second thing to emphasize, again, we've touched on it a few times today, that's all the other things that we do in portfolios to build in resilience to these types of shocks. It's impossible to predict exactly when and where and how the next geopolitical shock is going to happen. So how do we react to it? Well, we have all these things that I've talked about in our portfolios that help build in resilience. That is those shorter dated government bonds, those inflation protected government bonds, those diversifying strategies. And then it's when we select equities, prioritizing what we call quality companies, so companies with strong competitive positions, strong balance sheets that can weather change, can be resilient to volatility, and also companies that are exposed to these structural themes like Europe rebuilding its defense capability, Europe rebuilding its infrastructure as well, which are in some ways indirect consequences of this geopolitical uncertainty and volatility. So yeah, those are the key things from me.
Yeah, and I think I'll focus a bit more perhaps on the behavioural aspect of this as well, because Oliver mentioned emotion and uncertainty. I mean, we were talking, before we came on air about the fact that, maybe I can remember many, many years ago when I went on holiday for a couple of weeks and you'd go away and you wouldn't know what was happening in the world, and you got to the airport and you found a 2-day-old newspaper and you caught up on everything from football scores to politics. Yeah. Now it's in your hand, it's on all the time unless you choose not to. So, we can be much more affected by that than historically. And it's one of those key things, the less that you kind of observe what's going on in the world, the less volatility you experience, the less likely you are to make a mistake. And I think one interesting thing that's happening at the moment is that we're in kind of a normal sort of circumstances, you'd expect to see equity markets driven by long-term earnings growth trending higher with every now and again this sort of risk of a bit of a downdraft on some bad news. At the moment, we can almost turn that on its head in the equity markets because of all the uncertainty about what's going on in Iran, what the sort of duration of, closure of the Strait of Hormuz will be, what the knock-on effects are for all these other products that come out of there. We're in a sort of grinding downward trend at the moment. With every day that it carries on without a resolution, people just get more glum about it. But then the risk is the other way, that we get some good news, and that's exactly what happened yesterday when we saw this extraordinary morning where, just based on one social media post from Donald Trump, European equity markets, which are open at the time, jumped 4% in about a microsecond. So, you can see how easy it is, to kind of miss out on that recovery, because you'll never have a chance to react to it either. So that's why we very much talk about remaining invested during these periods, but obviously cognizant of the kind of tail risks that are out there and how we try to defend against that in portfolios as well.
Yeah, thanks, John. And so now let's move on actually to answer some of your questions coming through the chat. So during the conversation, I have been looking through the chat, and there's some really interesting questions. Some among a common theme, which seems to be the UK. I'm looking at you, Oliver. So perhaps I can consolidate some of these questions. What are your views on the UK market at the moment, factoring everything that's going on in markets more broadly?
So the UK is perhaps a little bit more exposed than some of its other developed market peers to what's been going on in the Middle East recently, for a couple of reasons. One, unlike the US, we've got that dependency on gas prices, so we're affected by the disruption to the gas supply. And two, because inflation in the UK was a little bit higher than in some of our peers, 3% in the UK, whereas it was just below 2% in the Eurozone, for example, on the eve of this. So we're a little bit more exposed there. The Bank of England, had events in Iran not happened, probably would have delivered some small rate cuts later this year. That now won't happen. It may slightly raise interest rates, probably not by as much as yesterday markets seem to think, a percentage point or more. I think that's going too far. But there's slightly more risk of this in the UK than, say, in the US or in the Eurozone, I think. So yeah, reasonable to kind of consider that specific risk to the UK, but see it in context as well. I mentioned this right at the beginning. This is not a 2022 style environment where inflation's already 6% and shooting up.
Yeah, I think, and there's another question relating to the outlook for, mentioned interest rates, but also gilts. Perhaps I can come to you on that, John. So what is the outlook, especially after the Iran shock?
Yeah, I mean, what we've seen already is quite a sharp pickup in the longer dated gilt yields and indeed shorter dated gilt yields as well. So shorter dated gilt yields are driven more by sort of short-term interest rate expectations, what's going to happen to the base rate, for example. As Oliver alluded to, a few weeks ago, before all this started, the market pricing was suggested 2, possibly 3 quarter-point interest rate cuts this year. As of early yesterday morning, it was expecting 4 increases of a similar nature. So a whole point on interest rates has come back a little bit over the last 24 hours. That's a massive swing in expectations. And I think to some degree driven by positioning. I think a lot of sort of traders were all in on UK rate cuts and they've had to unscramble very quickly. And now they've probably pushed it a little bit too far in the opposite direction, to be honest with you. So maybe a bit of opportunity there. At the longer end of the gilts curve, that's driven much more by thoughts about the sort of fiscal soundness of the UK government. And obviously one problem here is that recent events have probably taken away some of that fiscal headroom that Rachel Reeves had worked so hard to build back into her calculations. So it's up at around about £23 billion after the spring statement. Well, if we're going to have lower, economic growth potentially, if maybe there's going to have to be some subsidies to keep energy costs lower, if the interest rates are going up, that's going to increase the interest bill for the government as well. That all leans heavily on government finances. So again, there's an element there of sort of uncertainty about the fiscal situation, which has pushed the gilt yields somewhat higher as well. So we saw the 10-year gilt yield yesterday going above 5%. It actually came down to finish about 4.9 in the end. but that was the first time since 2008. So, that's a big shift that we've seen there. It's higher than it was during that, the Truss mini budget moment in 2022. There's definitely a bit of pressure on there. There's no doubt about that. But again, in the longer term, when push comes to shove, one would not be surprised if the Bank of England found some way to step in and to kind of lean on the market a little bit as well to keep rates down, if it really had to.
And what about government borrowing costs?
Well, as I say, at the moment, interestingly, the sort of fiscal situation had actually been improving a little bit with the growth that we'd seen. And also just happened to be, with the January tax take as well, there were some nice windfalls there from capital gains taxes going back to the, run up to the 2024 budget as well. So, we're not kind of deeply in the mire necessarily. Our, debt to GDP is under 100%. It's certainly higher in some other countries. And if anything, at least, Chancellor Reeves has kind of been quite consistent in her message that she's not going to sort of play loose and fast with the country's finances. But external pressures are somewhat coming to bear at the moment.
Well, to kind of tie this back to things that we've talked about earlier on, I talked a lot about how structurally we hold government bonds that are generally of shorter maturities than we would have done in the past. And it reflects all kinds of things, the geopolitical risk we've talked about and the kind of fiscal pressures that John's talked about. One of the kind of cleanest, most simple ways to insulate ourselves against all of those things is to hold shorter dated government bonds, because their prices are much less volatile, much less sensitive to these things than that longer dated debt. So kind of another reason for that bit of structural positioning that I've been talking about throughout.
I mean, you might be interested to know. So I did the numbers yesterday morning, so it might have changed a little bit since then. But if you'd owned a 2028 gilt, since the beginning of March, you'd lost 1%. If you'd owned the 2031 gilt, which is a 5-year gilt, you'd have lost 2%. If you'd owned the 10-year gilt, it was more like 3, more like 5 actually. And if you've gone really brave and gone for the 2061 gilt, you'd have lost 12% in March. So that's where the further out down the maturity curve you go to get the volatility. But that also means, there may be opportunities to do something the other way at some point when we think we see some value there as well.
Sure. Let's talk politics. This question interests me actually. So we're now only a month and a half away from the UK local elections, which are likely to be tough for the Labour Party. Should investors be concerned about a potential leadership challenge to Keir Starmer if things don't go his way? So I suppose the broad question is political uncertainty. Is that something we should be worried about?
Yeah, I don't know. I've got a catchy name for these webinars. It should be called The Rest is Politics. So I don't know which one of us is Alistair and which one's Rory. But yes, I think there should be concern over that. I mean, there's obviously rumblings in the Labour Party. I mean, we got a very thinly veiled kind of, leadership launch by Angela Rayner last week, for example. And, Andy Burnham had a go and was sort of pushed back. Wes Streeting is biding his time. So, I mean, I think there's a catalyst for this. There's obviously going to be the May local elections, and it looks like it's going to be a debacle for the Labour Party, and that will give the kind of, the non-Starmer people, shall we say, the excuse to launch a leadership challenge. Now that may be, undermine the stability certainly, and I don't think markets are going to take it too well necessarily if there are signs of a shift to the left and potential for more tax and spend, as it were. I think to that point as well, that is why certainly from a diversification point of view, having assets that are not denominated in sterling, i.e. global equities, but also a lot of big UK companies also get a lot of their earnings from outside the UK. That gives you that potential stability as well in a portfolio. But I always say, if you want to look at what kind of the market is thinking about politically, watch sterling. And now at the moment it's not too bad. It's at the upper end of its trade weighted range against major currency trading partners in the post-Brexit era. Well, obviously it came down very sharply there. Part of that in the short term is down to the fact that the European economy is actually in some ways seen as slightly more vulnerable than we are at the moment, and interest rates are lower there, so people can get a bit of pickup in interest rates here, for example. But keep an eye on that as the kind of, the litmus test for what the market's opinion is about political risk.
Yeah, sure. Oliver, I want to ask you about safe havens. We had a question, and it goes, do you view utilities as a safe haven at these volatile times?
Utilities are interesting because they're part of a theme that we've been talking about quite a bit, which is in a volatile global environment, there's a need for resilience, right? And utilities are part of that. Things that have happened in Iran, things that have happened in Ukraine, the pandemic, they've kind of exposed the fact that in Europe in particular, we've not been as well prepared as we could have been in terms of our sources of energy supply, of the way that our grid is structured and so on. So this is potentially a structural beneficiary from that as well, right? And there's a kind of indirect connection to the AI theme for a similar reason, because that's power hungry, because data centers consume a lot of power. So I think it's a sector that has traditionally been regarded as quite boring, but it's now quite interesting because it's tied into these structural themes which are related to the volatility, to the uncertainty in the world, and potentially long-term benefit from it.
Yeah. Gentlemen, really interesting insights. Thank you very much for your insights and for joining me. And yes, that brings us to the end of today's session. Again, a massive thank you to Oliver and John for their insights, and to you all actually for your thoughtful questions and for spending time with us. We hope you're leaving with a clearer view of how recent geopolitical developments fit into the wider market picture, how portfolios are built to navigate uncertainty, and where opportunities may be emerging as conditions continue to evolve. But before we wrap up, just a quick reminder about a couple of upcoming webinars. Firstly, we have a dedicated webinar on the Iran conflict this Thursday, the 26th of March. So if you would like to delve deeper into the topic, John will be joined by leading geopolitical and military experts to help make sense of this fast-moving situation. You can also register using the link on the screen now. And if you've enjoyed today's session, register for our next Investment Insights webinar scheduled for Tuesday, the 30th of June. And finally, please do take a moment to complete the feedback form. Your comments genuinely help us improve and make these sessions as useful as possible. So thank you again for joining us. Until next time, take care and happy investing.